Eric, how are you doing? All right?
Doing good. Had a good holiday. How about you?
Yeah, great, great. I hope everybody had a happy holiday. So it's a great holiday. I think we all enjoy just eating and having fun with our friends and family. Hope you didn't talk politics and you just had all a good time. Kind of rough weather for some people getting back home, but hopefully everybody is home nice and safe. Meanwhile, it's the same old story here in New York. Another bright day, as you can see from the window next to me. And however, it's getting cold here. It's starting to feel like winter, more like in the 30s. But I'm personally hopeful there won't be any snow. But my wife would like snow, so she's rooting for snow. So we'll see how it goes. Eric, I don't think you have to worry about snow at all. Let me turn off this contraption here, which is called a cell phone. All right, Eric. Lots of interesting things this week. It's another one of those jam-packed week, as we like to call it. Tell us a little bit about the labor market and what we're looking forward to. Also, we've got the Citigroup Economic Surprise Index looking weak, and it's working like a charm with the bond market. The bond yield came down from like 4.4, 4.5 down to 1.8. Now it's 4.23. My memory's still sharp, Eric. So that I think is what's been going on in the bond market. I'm thinking that maybe the bond yield is going to go up a little bit if the CESI goes up. Give us a little breakdown on why the Citigroup Economic Surprise Index might surprise us to the upside.
Yeah, so a lot of labor market stuff this week, as Ed mentioned. We have JOLTS, ADP employment, Challenger employment, and then the big grand finale will be Friday's non-farm payroll report. So, I mean, there was a really weak, we only had like 12,000 payrolls added in October, mostly because of Hurricane Milton. We had Boeing strikes, whatever the downstream impact was for Boeing suppliers or suppliers for hurricane impacted businesses. So we're expecting a big rebound this month. I think the difference between us and some of the other strategists is there's a lot of people forecasting a rebound just because October was weak, but like this general cyclical slowdown or kind of gradual weakening in the labor market, that's not really been our tune this entire year, and we're not changing it yet either. So we think payrolls could rise, 250,000, even more this month. And we're expecting that to be, part of the trend heading into the first quarter. So I think we're expecting really strong labor market data coming out this week. JOLTS is for October, so maybe JOLTS will still be a little weaker before rebounding. But I think that's, part of the story that people are missing, that the labor market still is really strong. So we could see a rise in the CESI or the CESI and bonds pick up a bit as people realize, hey, the economy is potentially even reaccelerating into the end of the year.
Yeah, I mean, the 3-month average increase in payrolls through October was 104,000. And we think that could go up to 200,000 in the 3 months through January. So, we could have a nice big rebound here in the November data on Friday, reflecting not just people coming back from strikes and these other one-off events, but also an underlying strong employment market. And then it may settle down to something a little bit lower than that, but still could have a 200 handle on it, 200,000 or so when it's all is said and done, 3 months through January. So that's kind of what we're looking at. And Eric, you forgot to mention one of the reasons we're looking for things to do better is animal spirits. There were a lot of animal spirits unleashed when during Trump 1.0, we saw some pretty significant rebounds in economic indicators, especially survey indicators, which were pretty pessimistic. And we've had this divergence between soft and hard data in recent months, where the survey data has been weak, and then the hard data about the real economy has actually been pretty good, generating real GDP growth of about 2.5 to 3%. So we could see a rebound here in animal spirits, which would boost the employment situation and might also keep the consumers going. You're doing some work on the consumer data that came out at the end of last week. What's your take on that? It looked weak, and it was one of the reasons that the CESI, the Citigroup Economic Surprise Index, was weak. What's your take on the data?
Yeah, we had incomes rise a lot, or disposable personal income rise a lot, and then some of that or more of that being saved versus spent. So, real personal consumption expenditures a little weaker than it's been. I think there's been a lot of revisions to this stuff. Maybe it's revised, but Black Friday sales look pretty good. Up like 3-4% year over year. Online sales surged. So, we'll see. But I think, the whole like everyone needs to save a lot more because we're running out of excess savings kind of got disproved or, thrown away when, personal savings and disposable income got revised higher. And we're not really too worried about it. We think, I think what Ed is going to talk about today is that specifically baby boomers and a lot of retirees who have a ton of, net wealth increasing from rising stock prices, rising home prices, they don't really have incomes and they're going to keep spending because of this wealth effect. So we're not too worried about it. I think, consumer spending could easily pick up into the end of the year, especially as Ed said, animal spirits kind of take over. But things look pretty good, I think.
Yeah, Eric, I've been doing this a while longer than you have, and what I've learned over the years is that any data that doesn't support our story is bad data, or it'll be revised. Or the weather, and it was the consumer numbers were were undoubtedly affected by the weather somewhat. I guess it's possible that people might have run out to the Home Depot to buy plywood and things like that, dealing with the hurricanes and all that. But a lot of stores were shut for a while, and so it's really conceivable that there was a weather effect in October on consumer spending, and that it will bounce back. Before we kind of look at the charts, which focus on me and my friends, the baby boomers, and what we're up to and why we're spending and keeping the economy going. Let's kind of think about the rest of the year. We're still looking for 6,100 on the S&P 500 by the end of the year. A few weeks ago, we revised it up from 5,800. And as soon as we did that, the market took a dive, and now it's back over 6,000. We think it'll have a year-end rally, and we characterize it as the Trump, well, I guess it should be the Don and Elon and Vivek and Santa rally, because we think all these things are coming together. The animal spirits and the perception that, on balance, the incoming administration's policies will be favorable for business, favorable for earnings, and favorable for the valuation multiple. Look, the past 3 years, the market's been fearing a recession, and we certainly had a bear market as a result of that, from January of 2022 to October 12th of 2022. And then the market kind of increasingly got confidence that, well, maybe we're not going to have a recession. Maybe the economy is resilient. And where are we now? Well, now we have to consider the fact that if the Fed raising interest rates from 0 to 5.25%, 5.5%, if that couldn't cause a recession, then maybe the economy really is resilient. And now that the Fed is starting to lower interest rates, we don't have to really worry about a recession caused by tight monetary policy, unless you're still a big fan of the long and variable lags of monetary policy, which we've been disputing for a while, as well as some of the other theories of what drives the business cycle and the monetary cycle. We've been focusing on the credit crisis cycle, and there was a mini crisis back last year in March. It did not turn into a credit crunch, did not turn into a recession. So I think the market can kind of check off fears that a recession anytime soon is going to cause a bear market. So what's left? Well, geopolitical crises in the past have caused recessions by driving up the price of oil, causing people to have to stand to wait in lines for gasoline. And we certainly had that in the 70s. I think we sort of had that even in 2008. We saw the price of oil spiking back then. And of course, in the early 90s, we had the war with Iraq, and that led to a spike in oil prices. But here we've had some awful geopolitical crises, and the price of oil has gone down. So there's plenty of oil around, partly because China is weak. I know China's PMIs, Eric, just came out, and they weren't bad. They looked like maybe the Chinese government isn't going to have to throw in a whole bunch of stimulus to revive their economy, but they're doing it the old-fashioned way. They're exporting to the rest of us, and it won't be too long here before Trump slaps some more tariffs on China. You've calculated what the current tariff on China from the United States is approximately what?
It's like 25 to 30%.
25 to 30%. And, Trump, of course, is a moving target. So I don't, last we heard he was talking about 10%. Before that, he was adding a 10% to that number. And then he was talking about 60% would be basically adding 30%. But again, looking at our economy, it certainly looks as though it's resilient. It's going to continue to grow. Earnings are going to be at a record high when we put all the numbers together for the third quarter for S&P 500 earnings per share. Eric, you're in charge of the controlling the slides here, so see if you can get them up. And we'll just do this briefly because I think we also are getting some questions here that we want to have quality time to respond to. So here you can see me there. You see me there in 1950, Eric. I'm right there in the little blue spot. That's when I was born. So I'm kind of in the middle of the baby boom, and as you can see, we've had quite a Eric. I'm not sure that are you seeing a screen shot of you and me on the side, or there's nothing there? Yeah.
We're
okay.
still
Good.
up.
Okay. Good. So the baby boomers altogether total 76 million. Next year, we decided to make sure this chart is still relevant next year. So we jumped the gun here, and for 2025, they're going to be 61 to 79. I'm not retiring, but a lot of my friends are retiring, and that means they're not earning income anymore, other than maybe dividend income and interest income. And for some, maybe that's sizable, but on average, I'm sure it's helpful, but it's not the kind of incomes that people are giving up by retiring. But they're doing that because they feel that they have nest eggs that will allow them to retire and to spend out of their retirement assets, which means that the savings rate is probably going to go negative in over the next few years. I don't know how soon it's going to happen, but I think it will happen, and that's nothing to get all weirded out about, though. I mean, the notion that we're running out of excess savings is going to kind of look funny in the with retrospect when we see a negative savings rate. I feel pretty strongly that that's what we're going to see, but that'll keep the consumer spending. That's probably one of the reasons consumers have been resilient. And then there's the Gen Xers and the Gen Ys, the millennials, and the baby boomers aren't going to live forever. When we pass away, we're going to leave some of the net worth to our kids, and but we're also going to leave them a lot of government debt. So we've talked about that in the past. Eric, next. Yeah, just skip this. This is just the same charts. This is kind of the net births versus deaths. This is the kind of a handy way to see how the baby boomers have affected the population. You can see that they entered the 16 to 19-year-old range there sometime around the early 70s and late 60s, early 70s, and then you can kind of see the bulge going in the boa constrictor here as the baby boomers are getting older, and the 55 plus group is the biggest group now, and that's because people are living longer, and it's the 55 plus. So as long as they live, they're going to be in that population group. Go ahead. This is another handy way to see the impact of the baby boomers on the labor market. So you can see that back in the 60s, the blue line, which is 16 to 24-year-olds, that's where they started working, either part-time or increasingly full-time. And then again, you can see the age wave moving through as they get older. What's interesting now is if you look at all the way to the right, you can see that the 16 to 24-year group is very small, historically small. And meanwhile, all the other groups have sort of coalesced in terms of percentage of the employment right around 22% or so. So it's a more even split in the demographically in the employment area. Go ahead, Eric. So here they are again. This is the seniors, 65 and over. For the civilian population is the blue line, and you can see the vertical line shows 2011 is when the baby boomers, the oldest ones, turned 65, and in 2029 we have when the baby boomers, the youngest, turn 65. So over this period, more and more are going to turn into seniors. More and more of them are going to retire. And as you can see, we've already seen a substantial increase in the civilian population, labor force, and those that are not in the labor force. This is a fun chart. This shows household net worth by generations, and we've shown variations of this quite a bit. David Yardeni, who is my son, so he is related to me, put together a lot of these charts, and I think they tell the story better than some of the charts we've been showing before. But you're looking at the total number is $154 trillion, not billion, $trillion in net worth of the household sector. And then if you look at the baby boomers, you got $79.8 trillion of net worth just with the baby boomers, and that's an all-time record high. So it's the richest generation ever. They're sitting on a lot of net worth in houses, in stocks, in pensions, in insurance reserves, and so on, money market, mutual funds, etc. Let's see if we can. Yeah, if you can flip through that one. That's just a shares look. This is corporate equities, and again, you can see that the baby boomers have a lot of corporate equities. So here they are retiring, and maybe maybe they continue to luck out here. That's been a generation that's really enjoyed an awfully good increase in their standard of living and in their net worth, and some of that was saved, but a lot of that was also due to appreciation of their stocks. And you can see that the stock ownership of baby boomers has increased dramatically, and some of that has to do with appreciation. Yeah, go ahead. Pass that one. That's the shares. So this is equity in non-corporate business. I think that's important. There are 30 million proprietorships in America, and these people own their own companies. And so you can see they have equity in non-corporate business, and it's substantial money. The total is $15.5 trillion, and the baby boomers have $7.8 trillion. Maybe some of them will hold their equity interest and let others do the work and still earn a nice dividend from that. Moving on. Go on, past the shares. This is a quick look at household real estate by generations. And you can see the baby boomers have a substantial real estate, but the Gen Xers are starting to be significant in that area, and millennials are just really starting to move more into having that as a substantial asset. Moving on. Yeah, this is let's go. That's a good household real estate owners' equity. So this is when it happens when you take out mortgages. The baby boomers still have a lot of net owners' equity. A lot of them have paid off their mortgages, and the net worth in real estate is reduced by the mortgage payments, by the mortgages that people have on their houses, particularly for Gen Xers and the millennials. Moving on. This is household pension entitlements. Again, a significant number, $17.6 trillion. Baby boomers, $9.8 trillion. Onwards. This is deposits and money market funds. So big numbers, 17.3 trillion for total. Baby boomers have 8.4 trillion, and then it's kind of distributed around the other generations. This is just deposits. Same story. We can pass on. And this is kind of interesting. This is just the money market funds and who owns them. And you can see that the baby boomers are sitting on a lot of liquidity yeah, just hold on that, yeah, $2.3 trillion is what the baby boomers have in just in money market funds. Go ahead. Oh, this is the mortgages. So you can see that back around 2008, the baby boomers had about a little over $5 trillion in mortgages. Now they're down to 2.6 trillion. So they have paid off their mortgages, a lot of them. And as a result, the owner's equity that they have has been boosted by them paying off their mortgages, plus the appreciation that their houses continue to experience with record home sales. You can see the millennials are accumulating some owners. Their accumulation of owners' equity is being impacted by the fact that they are actually increasing the mortgages they have on their houses. Consumer credit, well, that's the obvious thing there is the households with the most consumer credit increasingly are millennials. The Gen Xers have a fair amount. Millennials, not too bad compared to the other two. You can skip that. I think we're almost done. Yeah, this is just that savings rate story. This is personal savings rate versus the net worth over disposable personal income. I think a lot of you have seen this chart. We've shown it before. Other people have shown it. But the correlation seems to be even tighter with real estate net worth. You want to show that, Eric? Yeah, this is personal savings rate versus net worth over disposable income of owner's equity in real estate. And that also shows that as home prices have gone up, the savings rate has gone down. So that makes sense. And now there's going to be a whole new factor, and that is the baby boomers not saving at all and actually dissaving. Okay, moving on. Can move on from there. Just, all we're showing here is baby boomers spending has clearly been affecting things like fund-related services, gambling, recreation services, amusement parks. Go on. Also things like air transportation and hotels as they've been traveling, and of course, healthcare. Is there one more there? Oh, and then of course they've been helping their kids. This is the percent of people ages 25 to 34 living at their parents' home. So there's been a lot of intergenerational transfer of support of income, and that's also kept the consumer going. So all in all, the baby boomers have been an important reason why the consumer spending has been resilient. Eric, I'm sorry that we're doing this to you and your friends. We're leaving you all this debt, and we're going to live really long and spend it all. But we'll try to leave you something. Anyways, why don't we open it up for some Q&A? Eric, you want to read some of the questions and take it the ones that you'd like to field?
Yeah. So this one is from Cactus. Hi, Ed. When the SESI turns up or down, it typically goes in that direction and trends for a while. How do you tally that with your view that the SESI is going to come back up soon again?
That's what we're here for, to forecast and not necessarily look at things. I mean, we do what you do, and we look at it that way. But our forecast is not consistent with the view that the CESI is going to continue to dip here, and we think a lot of the weakness in the CESI is not an inflection point in the CESI. We think it's just a soft patch related to weather, hurricanes, Boeing strikes, and the like. And so we're expecting some pretty solid numbers here for personal income, retail sales, just employment. So that's where we're at.
And then as a corollary, what's your target range for the 10-year for the next 6 months?
Well, I think we were asked this by Cagdis last week, and things were starting. Besant was dominated by Trump, and the bond market had a good day on Monday, and it continued to rally last week by about yields came down by about 20 basis points. We got down below our range, which is still 4.25% to 4.75%. So we're still there. Eric's done a lot of good work on the underlying inflation. Eric, it feels a little strange because ever since 2022, we've been promoting the idea that inflation is going to come down a lot faster than people thought, and now we're just kind of arguing that, well, some things are kind of sticky here. And while things got to where we thought they would get, but, that was then, this is now. And what we see now is some stickiness and inflation that could be something that the Fed needs to focus on. Go ahead, Eric.
Okay. So there have been some comments that the deficit will be lower next year versus this one. Do we agree? And this is before any action from Doge, Elon and Vivek.
Want to take it, Eric?
Yeah, I mean, there's a lot of unknowns with Trump coming into office, and then whatever happens, I think, with the corporate tax rate as well. In Trump 1.0, we cut the corporate tax rate from what, 30 something percent to 21. And, corporate tax.
Eric, the timing, as you said, the timing is the issue. And back then, that finally made it through into an act at the end of 2017, his first year, and it actually kicked in 2018. So we're kind of clueless on how this all plays out. I think it's safe to bet that the Republicans are gonna ram through whatever, maybe 1,000-page bill, trying to do everything they can all in one shot, figuring that they might lose the midterms, and meanwhile they might also lose their own internal agreement on things. So if that's the case, it's going to be a tough call either way.
Yeah, I think Doge, their mandate ends in like mid 2026, so presumably they'll be off to the races in January.
Yeah.
Ed, what is your view on the rate curve? Seems like twos, tens, reinverted. Any reason or thoughts for that?
Eric, why didn't you do it? Because you just wrote about possibly a flatter yield curve in our future.
Yeah, I mean, there's an interesting analog looking at the late 90s, so 1995 on, which was kind of the last soft landing, so to speak. And the yield curve was only like about positive 50 bips upward sloping, because you had higher for longer short-term interest rates, and then 2.5% real growth, 2.5% inflation. So that very well could be the story, but I think why we reinverted is the market just expects the Fed will have to keep rates higher for longer, as economic data has been quite strong, and there's nothing to suggest it won't be. So if you have the Fed keeping rates above 4% and the 10-year reflects some fair value around 4.25%, 4.75%, it makes sense that the yield curve is a bit flatter, but it doesn't precipitate a recession or anything like that. I think we've dispelled that quite a bit.
Eric, you want to take two more questions the time we have left?
Yeah. See how much you want to comment on this one. We did write about it recently. So with a new story every day about a company buying Bitcoin, MicroStrategy, triple levered ETFs, the strategic Bitcoin reserve, etc. When does Bitcoin become overheated?
Well, become overheated when the Ardeni Research starts to issue some convertible debt and buy Bitcoin. I mean, it's such a amazing model. I'm surprised that it hasn't caught on. There's a lot of people looking at that model and just saying it's kind of the creating the biggest bubble of all times. And I saw Tom Lee, who's very smart, does really good work, a good competitor for sure. Put a very positive spin on it. But he kept saying that it'll work as long as Bitcoin goes up. And we've discussed our analogy for Bitcoin is digital tulips, and we don't say that in a negative way. We just say it in a factual way, that the difference between Bitcoin and the tulip mania in Amsterdam is the tulip mania was just in Amsterdam, and there was the market was open just during the day, and at some point, it didn't take long to saturate the market for the last sucker there being opinionated. Yeah, the last sucker to buy the bulb, and then the whole thing, you couldn't find any more buyers, and the whole thing just kind of imploded. The big difference, and it's a huge one, is Bitcoin is traded 24/7 globally. And there's a lot of people like me and lots of others who don't own Bitcoin. So I guess when I finally am converted, that'll be the top for sure. But in the interim, I can't for the life of me figure out, you know, how this keeps working. I mean, it's kind of like a fountain of youth. It just keeps working and working until it doesn't. So I can't come up with it. If anybody wants to, Eric, you got any theories of what's going to pop this? I mean, it's could potentially be the biggest bubble of all times. And then the question is, if it doesn't pop, then was it really a bubble? And if it does pop, then we can say, "Ah, see, we told you so."
Yeah, I feel like all the ancillary stuff that isn't Bitcoin, all the other crypto things, are typically the leading indicator there. When that stuff kind of taking off doesn't really make sense to me. Seems just like a liquidity thing, kind of like 2021, animal spirits, whatever.
Yeah.
But seems like very real institutional buyers, whether foreign governments or like, when you make an ETF tied to Bitcoin, right? Like you have to actually buy Bitcoin. So it seems like there's some fundamental support there. Why is gold worth $2,000+ it's technically not that valuable. But so I guess it keeps going up for now.
Yeah.
I can't think of anything else.
Okay. I think did you have one more, Eric, or that was it?
No, I think we're good.
Okay, good. All right, Eric, thanks as always for joining me. Max has left the room like Elvis, and we'll see you all next week. Have a good week. It should be an interesting one indeed. Thank you.
Take care, everyone.